Starbucks Corporation, ticker SBUX, is currently trading at $75.30. And over the past month, actually on the day when they announced their earnings on April 30th, the company fell by more than 15%. Now, this begs me to ask the question whether it is a good idea to buy Starbucks at its current trading price, or if you should wait for it to drop even lower. Now, first of all, we want to have a look at why the company fell by 15% when they announced their earnings. The year-over-year comparable store sales declined by 4% and the operating income was off by 6% to only 1.15 billion. Now in this video I want to dive into Starbucks and I want to really explore and explain why the drop in the stock price of Starbucks is very irrational and why I think that you should buy the company at its current trading price. And to do this, we'll jump over to my stock valuation spreadsheets, which I've created to simplify the valuation of any company. Now, the first thing we will do is plug in the ticker of Starbucks, SBUX, and all the metrics will show up automatically. Now, in these sheets, we will find everything we need to evaluate any company. So the first thing we will have a look at is the 9-pillar analysis for Starbucks. We will have a look at its history and analyze whether internally the company is doing well and whether it is set to do well in the future. We will also use the 4 valuation models, the Graham's formula, discounted cash flow model, multiples valuation model, and the dividend discount model to arrive to the ultimate intrinsic value of Starbucks at the end of the video. Now let's get straight to the evaluation. And the first thing we want to have a look at is the current dividend yield of Starbucks, which is sitting at 3.03%, which is a great dividend yield for a dividend growth company such as Starbucks. Now, this gives us a dividend payout of $2.28 and a trailing free cash flow payout ratio of 73.86%. Now, we are using the free cash flow payout ratio as dividends of any company are paid from its free cash flow, and therefore it is a more viable metric than the general payout ratio, which takes into account the net income of a company. Now, below here we can also see that the company has dropped by about 30% since the prior year, which is a huge drop in price and opens up an opportunity to buy the company at a discount price. We can also see that the analysts currently project the price of almost $100 by the end of the year, and the beta of the company is sitting at 0.97, which means that the company is very much not volatile and is fairly similar to the S&P 500. Now we can move to the first valuation model, which is the 9-pillar analysis. And here the first thing we want to have a look at is the 5-year PE ratio, which is currently sitting at 42.68%. Now this means that you would be buying Starbucks at quite a high premium, which really should be expected for any large company such as Starbucks. Now we can also see that the price to free cash flow over the past 5 years is sitting at almost 30. Now this metric is very similar to the first metric we had a look at, but instead of earnings we have a look at the free cash flow of the company. Now we can also see that Starbucks has actually been buying back shares over the past 5 years, currently decreasing their shares outstanding by about 1.13% per year. Now this is great news for any investor, as this means that in the long term you will own a larger percentage of the company. Now, more positives for this company is that they have increasing free cash flow over the past 5 years, increasing revenue and increasing net income, all sitting at very high percentages, with the 5-year profit margin sitting at almost 70%. Now for the increasing free cash flow, we can scroll down to the financials and see that actually the free cash flow has been increasing quite well over the past 5 years. And we had a huge surge in price here, that's why the percentage up here on the top is slightly off. And this is something you always have to check when using these sheets. Now one more metric I really want to have a look at is the long-term liabilities over the 5-year free cash flow negative dividends, which in general we want to be sitting below 3. Now for Starbucks this is sitting at 7.56, which means that the company would be able to pay off all their long-term liabilities in about 35 to 40 years. Now for most other smaller companies this would be a deal breaker for me, but as Starbucks is a large secure company, this doesn't really bother me that much. And finally, we can also see that the consecutive dividend growth is sitting at 14.69% per year, which is great for a dividend growth company. Now moving to our first valuation model, the Graham's formula. Now here we take the trailing earnings per share instead of the current earnings per share, as we really want to evaluate the company over the past 5 years and figure out whether internally over the long term it is doing well. So that is why we take the trailing earnings per share, the base PE 5-year growth estimate growth rate multiplier, and the average yield of AA corporation bonds and the current yield on AA corporation bonds. Now because we are using the trailing earnings per share, we don't take the current yield on AA corporation bonds, which is sitting at about 5. We take the short-term average, which would be sitting at about 3.52. Now the intrinsic value after this valuation comes out to be about $84.93, which is 11% higher than the current trading price, and with margin of safety of 10%, we would have an acceptable buy price. Now this is only the first valuation model. We are now moving to the next valuation model, which is the dividend discount model. Sorry, not the dividend discount model, the discounted cash flow model. Here we take the free cash flow over the past 10 years or so and calculate the average growth rate to be sitting at 381%. Now again, when using these spreadsheets, you really have to have a look at what you are evaluating, as the math can be off sometimes. We can see that there has been a huge surge in price from 2020 to 2021, rising by almost 4,000%, and that is why this huge rise in price for the average growth rate. Now we can see that the average growth rate would be sitting at about 11% year over year, with the analyst growth rate projections for the next 5 years sitting at 7.77%. I would calculate the growth rate at about 8%. And when I calculate the growth rate, I then use this growth rate to calculate the future free cash flow of the company and arrive to the terminal value. I then take the discount rate and calculate the present value of that future free cash flow. I then sum up all that future free cash flow, add any cash and cash equivalents, subtract total debt, and get an equity value, which I divide by the shares outstanding and get an intrinsic value of $140.98. Now moving to the next valuation model, where I have already plugged in the ticker symbols for the 3 companies we will be comparing Starbucks to. These are Chipotle, Yum, and McDonald's. Now here we take the company's current stock prices and divide by their earnings per share to get their PE ratios. We then average out these PE ratios and multiply by the current earnings per share of Starbucks to get an intrinsic value of $139.65, which really shows us that Starbucks is indeed doing better than companies which operate in the similar sector. Now moving to the final valuation model, the dividend discount model. Here we take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 8.95% per year. Now I project a growth rate of 8% per year, which I will use to calculate the next year's dividend. Now as we can see, the intrinsic value for this dividend discount model comes out to be negative, and the reason for this is when the WACC of the company is sitting below the projected growth rate, the intrinsic value, the math in the intrinsic value comes out to be negative. And that's why we have our alternative dividend discount model, which uses the stock price next year predicted by analysts and our calculated next year's dividend, which we calculated using the projected growth rate and the WACC of the company to calculate the intrinsic value to be sitting at $93.32. Now moving to our ultimate valuation, we can see that we average out the 4 valuation methods we did, and we get an intrinsic value at $108.22. Which is 43% higher than the current trading price of the company. Now for Starbucks, we don't really need a margin of safety of 20%, even though if we did use a margin of safety of 20%, we would still get an acceptable buy price at $86.58, which is higher than the current trading price. But we can also plug in a margin of safety of say 10%, which would give us an acceptable buy price at $97.40. Now you certainly shouldn't base the purchase of shares of any company on only the intrinsic value that you calculate. You have to do your own research in the background and figure out whether the company will really grow in the next years. Now based on this valuation and based on the 9-pillar analysis we did and based on my research which I did in the background, I did buy Starbucks about a month or 2 ago, and I keep buying as it keeps falling. With that, if you find these spreadsheets helpful and would like to download them for yourselves, you can access them at my Patreon in the link in the description. If you enjoyed the video, make sure to leave a like and let me know down in the comments which company you would like me to evaluate next.